Ever wondered about the mysterious world of hedge funds? You hear about them in movies, usually run by some slick character in a fancy suit. But what do they actually do? And why do they have such a massive impact on the global economy? Stick around, because today we read pulling back the curtain on hedge funds and demystifying their role in the financial universe. So, what exactly is a hedge fund? At its core, it's a private investment partnership. Think of it like an exclusive club for wealthy individuals and institutions, known as accredited investors. Unlike your standard mutual fund that you or I might invest in, hedge funds have way more freedom. They aren't as heavily regulated, which allows them to use a wider and often more complex range of investment strategies. This flexibility is their superpower. They can invest in almost anything: stocks, bonds, currencies, commodities, real estate, you name it. Det kan also gå along, SS-pri, or short, betting'll go down. This ability to short sell is a key differentiator. The name hedge fund itself is a bit of a clue. The original idea, pioneered by a guy named Alfred Winslow Jones back in 1949, was to hedge or reduce risk. His strategy was to buy stocks he thought would do well and simultaneously short stocks he thought would do poorly. The goal was to make money regardless of whether the overall market was going up or down. This concept is called market neutrality. While some funds still focus on this, many today are far more aggressive, aiming for high returns, which often means taking on significant risk. So, how do they actually operate? Hedge fund managers are the brains of the operation. They are often some of the sharpest minds in finance, and they use sophisticated analytical models and extensive research to find market inefficiencies. They might use strategies like global macro, where they bet on broad economic trends across different countries. For example, if they believe a country's currency is overvalued, they might short it. Another common strategy is event-driven investing, where they capitalize on specific corporate events like mergers, acquisitions, or bankruptcies. Think of them as financial detectives, constantly hunting for clues that will give them an edge. Now, let's talk about their impact on the markets. It's huge. Because they manage trillions of dollars, their collective actions can move prices. One of the most important roles they play is providing liquidity. By actively buying and selling a vast array of assets, they make it easier for others to trade. When you want to sell a stock, there's a good chance a hedge fund might be on the other side of that trade, ready to buy. This constant activity helps make markets more efficient. They are also pioneers in price discovery, because hedge funds spend so much time and money on research. They often uncover information that the rest of the market hasn't noticed yet. When they act on this information, their trades signal to others that a stock might be under or overvalued. This process helps asset prices more accurately reflect their true worth. For example, if a fund discovers a company has been hiding some bad news, they might start shorting the stock. This selling pressure drives the price down, alerting other investors to the potential problems. In this way, they can act as a check on corporate mismanagement. However, the power of hedge funds is a double-edged sword. Their aggressive strategies and the sheer volume of capital they control can sometimes lead to increased market volatility. Remember the GameStop saga? That was a classic example of a battle between retail investors and hedge funds that were heavily shorting the stock. Large, concentrated bets can create dramatic price swings. And when a big fund gets a trade wrong, the fallout can be significant. The collapse of long-term capital management in 1998 is a famous case study. This massive hedge fund, run by Nobel laureates, made a series of bad bets that nearly brought down the entire global financial system, forcing the U.S. Federal Reserve to step in and organize a bailout. This brings us to the topic of regulation. Because of their potential to destabilize markets, there's an ongoing debate about how much oversight hedge funds should have. After the 2008 financial crisis, regulations like the Dodd-Frank Act in the U.S. were introduced to increase transparency. Hedge funds now have to register with the Securities and Exchange Commission and report more information about their holdings and strategies. The idea is to give regulators a better view of the potential risks building up in the system. However, finding the right balance is tricky. Too much regulation could stifle their ability to provide liquidity and aid in price discovery, while too little could leave the system vulnerable to another crisis. So, are hedge funds a force for good or a source of instability? The answer, like most things in finance, is complicated. They are a critical part of the modern financial ecosystem. They drive efficiency, provide liquidity, and uncover valuable information that helps keep markets honest. They offer sophisticated investors a way to diversify their portfolios and potentially achieve returns that aren't tied to the general market's performance. At the same time, their pursuit of high returns can lead them to take on immense risks, with potential consequences that extend far beyond their own investors. Their complexity and secrecy can make it difficult for regulators to keep up, and their power can sometimes be used to exploit market loopholes rather than correct them. Ultimately, hedge funds are a powerful tool. In the right hands, they can contribute positively to the functioning of global markets. But, like any powerful tool, they also carry significant risks. Understanding their strategies, their impact, and the ongoing debate around their regulation is crucial for anyone interested in how our global economy really works. They are not just for the ultra-rich. Their actions ripple out and affect us all, from the price of a stock in our retirement account to the stability of the entire financial system. Thank you so much for joining me on this deep dive into the world of hedge funds. I hope it cleared things up for you. If you found this video helpful, please give it a thumbs up and don't forget to subscribe and hit that notification bell so you won't miss our next exploration into the fascinating world of finance. See you in the next video.